interesting because we have even the currency markets moving, the bond markets moving, everything but really the equity markets. And so no shortage of things to talk about just on there. So let's just give it a few more seconds here and make sure everything's going, and then let's dive right into this. All right.
Let's go.
So, hello everybody, and welcome. So, gold, big reversal day coming in. Is this the start of something much bigger, or should you buy the dip? This is a simple conversation, but has to have a lot of context put into it. So let's not waste any time. Let's dive into this chart. Let's take a look. What we have: gold down over 5%, down $230 at its biggest. It was down $250 on the downside. You know, everyone's talking about a $300 correction in gold, but to happen in almost in one day is extraordinary. But shouldn't be a total surprise. One of the things that I talked about yesterday in the other YouTube video was the fact that we had implied volatilities on gold more than double in a month. The implied daily ranges just skyrocketing because of this exponential rise in gold. And so gold makes this huge move on the upside. One of the things that we highlighted was that what we didn't necessarily know was how high gold could necessarily go. But one of the key calls is that when the short-term top is in, that the downside move will be as violent as the upside move. And I wanted to help all of you better understand why these things happen in the markets, and more importantly, what should you expect from gold from this point on. So I always say, over the long term, fundamentals are where almost all valuations go, and based on, gold has a fundamental reason to be higher. And we can go you can go to any one of our Macro Voices episodes and listen to any big macro guest to understand the framework for why someone should be long-term bullish gold. But I always say to my big picture trading members that over any short to intermediate time frame, prices are a function of liquidity, not their fundamental value. And this is very hard for people to grasp because they want to anchor off the long-term fundamentals, but not understanding what drives these short-term flows. Now, the one thing that you must anchor off of is that gold, silver, platinum, palladium, gold miners, silver miners, you name any of these securities, they have been the best performing asset this year. There is a very large amount of traders and investors out there that I call stock renters. And what they do is that they need to always be owning the things with the greatest momentum. Now, when I call them stock renters, because in the end, they're not there for the long term. They're there only because the momentum is there, and they come in with huge margin, huge amounts of leverage, and they often are using options to lever up those upside returns, which means that dealers have to deal with huge amounts of gamma that they're hedging out. What does this all mean? It means that volatility is the only certainty, and volatility in both directions, both to the upside and the downside. What you want to think is that there's a long-term fundamental value of gold, which is, let's say, the average price over the course of a year. And then there's these short-term moves that are happening along the way. We were overdue for one of these short-term highs. So is this one legitimately it? It definitely feels like it. There's a couple of reasons why. Well, first of all, this is a bearish engulfing candle, but there was a bearish engulfing candle that came in here on Friday. The interesting part was on Monday, we had a bullish break to the upside that attempted to reverse it. Now, it failed to make a higher high. What we've basically seen is almost for 4 consecutive trading sessions, there was an upper ceiling of gold up near the 4,400 level. But while gold yesterday managed to go all the way to its highs, there were a couple things that were not confirming. Number one, silver yesterday was not able to make any meaningful recovery. You can observe that very tiny green candle on the upside. And when you go look at gold miners, which are down 10% today, or they're down over 15% in just the last 3, 4 trading sessions, there was almost no meaningful recovery as they started to break down between Friday and Monday on the upside. And so while gold was recovering, the other areas continued to distribute. That's also the case with platinum and palladium, which barely recovered yesterday, and palladium as well barely recovered yesterday. So we have these big, deep corrections underway. Now, I want to stress one important thing. First of all, everything I say needs to be put in the context that I remain very bullish gold in the long term, right? I actually continue to, like, I'm one of these gold bulls that thinks that, we're going to see $10,000 gold this decade or even more. I'm long-term bullish gold, but I'm a trader too, and I also study price action and I study the ebb and flow movement because I'm always looking for asymmetry in opportunities. And the question is, when a gold move like this happens, it's no longer asymmetric to be doing new buying. You need these reversion moves to reset the asymmetry of trade, to give new opportunities to reposition and go long. So what should you expect here? So looking back at this chart, what we often want to do as a base case is anticipate that there could be as much as a 50% retracement, which in this case is a move back to 3,900 or another $200 an ounce. I think that is a very realistic first short-term target. Now, I want to highlight, though, from a time frame perspective and depth perspective, let's go back. I'm going to put it first on a weekly chart. I want to stress that there have been three key consolidation points in gold in the last 2 years. There was, and each one of these three consolidations right here lasted anywhere from 2 to 4 months in their length. And each of these corrections, peak to trough, was about a 7% drop in gold. This second one over here was about a 9% drop in gold. And this one, peak to trough, was about an 11% correction in gold. We are going to see some sort of a correction. These things happen all the time in gold. It's basically, think of gold like a set of lungs, like all assets, and they breathe in and they inhale and they inhale and exhale. And you don't want to naively believe that a market will only inhale and never exhale. That's just not the way the markets work. So here we are, one day into a market correction. The previous market corrections lasted 2+ months. And so if this follows any sort of a similar time frame, then you have to be expecting that gold may be in consolidation for the rest of the year. This will lead to the next major buying opportunity. The question only now is how far and how deep do these corrections go? Now, gold itself may not correct remotely as deeply as some of the other assets, such as gold miners. I want to put some context into this. Now, gold, the likelihood that gold, let's say Eiffel Towers, and does a full correction to 3,300, I would put as an outlier. Very, very small probability. Probability isn't zero, but I would not give it a high probability. I certainly wouldn't be short selling gold. But the volatility that gold miners might experience here may be more volatile. Now, I want to frame it this way for all of you. I'm going to use uranium. Particularly, I'm going to focus in this case on Cameco, which is also correcting right now. But now uranium had an extraordinary bull story going on from 2023 to 2024. We saw, several 100% advance on the upside of uranium. The story at the end of, or the middle of early part of 2024 was really bullish. Everything was great, up several 100% on the upside. And then Cameco went through two violent market corrections. I want to highlight two things. One, the bull story of uranium never once changed during these corrections. And anyone who bought and held through the corrections came out on the other side with another major bull impulse that saw another 100% rise. But during this period, driven solely by liquidity and these profit-taking cycles that occur in these lungs expanding and contracting, you saw two corrections in Cameco. One that happened in 2 months that was 37%, and a second correction that was over basically 4 months that was 44%. And that's not just Cameco. When you look at the entire uranium stock basket, that was a 32% correction in the ETF, and the bigger drop was about a 40% correction. Point here is that these kind of moves, like in these ETFs, can be that pronounced, and especially regarding the fact that the GDX and the gold miners went up 150% in a span of like less than a year, then them turning around and giving a correction, let's say a 30% correction, is the GDX going back to $60. A 40% correction would be it going back to $51. Now think about this. That's going to levels where it would still be above where we were trading this summer. Levels that are higher than where we were trading this summer. So the idea that this is out of reach and this is a far-fetched idea is it's totally in the realm of possibility that the correction. Now that will be an epic buying opportunity if that is, but the key here is to be hedged up. You need to be putting on some way of protecting your positions. Now we at Big Picture Trading, we converted a lot of our trades from being long these high delta, deep in the money leaps because we were making a pile of money on the upside. We converted them up along the highs into bull call spreads, shorter term ones. So what we did was we pulled all of that huge intrinsic value out of the options, took the multiple hundreds of percent return on these leaps off of there, and we replaced them with bull call spreads that allowed us to keep participating on the upside if gold kept going higher. But yet we took the vast majority of the money off the table and allow ourselves to be in a position to buy the dip. And we are going to be buying the dip. The thing is, this correction is just getting underway. This, in my mind, should not be bought on dip today. Now, if you are a day trader, yes, can you get a reaction on the GDX bouncing from 72 to 75 to $76 on a small fib retracement on an hourly chart basis? You can, but generally you have to think that you should use the framework of the length of previous market corrections, usually in the 1 to 3 month time horizon, is what you should be expecting this correction to play out. And so you want to think that some of the best gold buying opportunities from this correction are probably in late November to early January. And so at this moment, play defense, hold above average amounts of cash, and do some sort of hedging to make sure you have some of that downside risk blunted, because you want to be able to make sure that you're able to have the staying power to hold through either positions that you already have, or to have an inflow of cash from those hedges to be able to dollar cost average them. And that is a very powerful thing to be thinking about. Point here is you want to be tactical about this in here. This is a very rapid, quick crash that's getting underway. You can see the margin calls coming in here, like just simply people being liquidated from these huge drawdown sequences. And so at this moment, there's going to be a lot more of this short-term volatility. Now, one thing I want to highlight is I want to use some of the previous gold market tops so this is GDX. Let me just quickly switch it to gold. I want to use some of the previous gold tops to kind of give you a framework of what to expect. What you can observe here is back over here, gold in 2022 went through this first short-term top that basically saw about a 7% drop in gold that happened over a span of a week. And then it traded sideways and then even higher for almost a month before it continued lower. If you go back to, let's say, the 2020 peak in gold, what you can observe here is that gold came in first after it peaked with this bearish engulfing candle, basically within 4 or 5 trading sessions was down about 8-9%. But look at the bounce that happened in the days that followed. So it bounced. Now, in the end, gold stayed in a corrective mode for months. But the point here is that sometimes panicking, and if I hope I'm not encouraging anyone to panic, panicking during this red candle is usually not the best idea. There's going to be a market bounce. And the way you want to think about it is this: inevitably we're going to get a bounce. Maybe what we're going to see is gold go peak to trough. Let's just use the analog of that sell off, and that it's a 7% correction. So let's say gold gets down to 4,000. Right, and let's say 9% correction. This gets down to here in one more quick drop. The odds then are that there's going to be that kind of a bounce, and the bounce could easily see a price rise back above 4,200 in the bounce. But you got to be careful, because if that bounce does not make a higher high, it's going to be sold into. And so you want to, that's the window where I would be actively adding hedges for those of you that have not yet hedged up your portfolio. But nonetheless, we're calling the play-by-play on this at Big Picture Trading. So any of you that want to trade along with me, you can. The links are in the description below. But gold has definitely started a correction here, and we're going to see how deep it goes. Trust me, I'm long-term bullish gold, and I'm going to be focused on where the next major buying opportunity is. There's going to be an awesome one, so let's discover where it is. I'll keep all of you up to date on YouTube as well.